I was thinking about how most people visualize a sale.
Okay.
It seems pretty straightforward, right? I have a product, let's say a toaster. You want it. I put it on a truck, send it to your house, and you pay me.
Simple as that.
End of story. Transaction complete.
It sounds perfect. And honestly, if you're running a lemonade stand, that model works. But in the world of enterprise ERP, specifically SAP sales and distribution, that simple model is, well, it's basically a fairy tale.
A fairy tale.
Completely. It's the exception, not the rule.
Yeah.
And if you assume every sale works like that, you are going to break the system badly.
And that is exactly why we're here today. We are taking a deep dive into the messy reality of SAP SD. We're moving way beyond those basic sell from stock scenarios and looking at the really complex, high-risk situations where possession and ownership are two completely different things.
This is the stuff that separates a junior consultant who just, follows a menu path from a solution architect who actually understands how a global business operates.
We're talking ghost inventory, legal minefields,
And hidden financial debts that can absolutely ruin a CFO's quarter. Yes.
We've got a massive stack of notes here, from consignment stock to the absolute chaos of a project cutover. The mission today is to figure out how companies sell things they don't even have yet.
And, more importantly, how to keep the finance department from screaming at you.
Right.
And if we do our job right, by the end of this, you'll understand what I call the golden thread.
The golden thread.
It's the ability to track three things through all the noise. Who owns the stock? Who holds the risk? And, crucially, when does the accountant actually get to smile?
I love that. When does the accountant smile? Which I assume is rare.
Very rare.
So let's start pulling on that thread. The core concept you mentioned is decoupling possession and ownership. In my toaster example, those happen at the same time.
Exactly. In a standard sale, title and risk transfer the moment the truck leaves your dock.
Cool.
It's not your problem anymore. But in these advanced scenarios, we break that link. And the best place to start is with consignment.
Consignment. This is the forward deployed model, right? It's my stuff, but it's sitting at your place.
Precisely. Let's make it real. Imagine you're a medical device company.
Ah.
You sell, titanium knee implants to hospitals.
Okay.
Now, a hospital can't wait 3 days for shipping when a patient is already on the operating table.
Right. They need it right there on the shelf, instantly.
So you, the manufacturer, put a whole rack of your implants in the hospital's supply room. Physically, the stock is at the customer site, but legally, you still own it. It is on your balance sheet.
The source material mentions that sales teams absolutely love this, but operations teams, they hate it. Why the conflict?
Oh, yeah. Sales love this because it's the ultimate competitor lockout. If your inventory is filling up their shelf, there's no room for anyone else's product.
Instant gratification for the customer, too?
But operations, they hate it because it creates ghost inventory.
Ghost inventory.
The system says we have 5,000 units, but we can't see them. We can't count them. We are relying entirely on the customer to tell us what's going on. If that hospital has a fire, that is our asset going up in smoke, not theirs.
So how does SAP even handle this? It can't be a normal sales order if we still own the product.
It's not. This is a classic interview trap, actually. Consignment isn't one transaction. It's 4 distinct phases, and you have to get them right. The first phase is the fill-up.
Okay, the fill-up. You move stock from your plant to the customer.
Right. The truck leaves.
So why send an invoice?
Absolutely not. And this is critical. If you trigger an invoice during the fill-up phase, you have effectively committed tax fraud.
Whoa. Hold on. Tax fraud.
Think about it. Have you sold anything? No. You've just moved your own property from your warehouse to a different room. No title has transferred. If you bill for it, you're recognizing revenue that doesn't exist.
So when does it actually become a sale?
Phase 2, the issue. This is the moment the surgeon opens the box and uses the implant. The hospital reports, hey, we used 5 of your widgets today. That is the moment of sale. Ownership transfers, and the system can finally trigger the billing.
And then you have pickup, bringing on used stock home, and returns. But I saw a note here, a senior insight about valuation, something about the moving average price.
Ah, yes. This is a huge financial headache. Let's say you ship that implant in January. It costs you $100 to make. It then sits on that hospital shelf until June.
Okay.
By June, maybe the cost of titanium has spiked. That same implant now costs $150 to produce. Now, the customer uses it in June. The question is, which cost does the system use to calculate your profit margin? The 100 from January or the 150 from today?
I would assume the cost from when I shipped it, from January.
You would think so. But standard SAP behavior often reevaluates at the time of the issue. It grabs the current value. So your report might show your margin has collapsed, not because you sold it for less, but because the replacement cost went up while it was just sitting there.
That's wild. So the golden rule here is billing defines the sale, not the delivery.
Exactly. They are time travelers, separated by months.
Okay, let's flip the script. Consignment is my stuff at your place. What about when we sell something we don't even touch? Third-party sales.
This is the pass-through commercials model. You see this everywhere in e-commerce, with dropshipping.
Right. You order a laptop from some website, but
Yeah,
the
right.
box that arrives is straight from the Dell factory.
The website never touched it.
Yeah.
We are just the middleman handling the paperwork and taking a cut.
So how does that work in SAP?
It creates what's called the triangle. You enter a sales order. The system sees the item category, usually TAS, and it realizes, wait, we don't have this. We don't even carry this. It then automatically generates a purchase requisition for a vendor.
So the sales order talks directly to procurement.
Correct. The vendor ships to the customer. The vendor bills us, and then we bill the customer.
It sounds efficient, but the notes highlight a massive risk with billing relevance.
It's the risk of jumping the gun. In a standard sale, you bill when your truck leaves. But here, there is no truck. If you don't configure it right, you might accidentally send an invoice to the customer the moment you create the order.
Before the vendor has even shipped it.
Exactly. You're charging for goods that might not even exist yet. That's a great way to destroy a client relationship. The system has to wait for proof, which is usually the vendor's invoice to you.
I see. There's also this weird term here, statistical goods receipt. Why are we doing a goods receipt if the goods never touch our warehouse?
Control. Some companies are, let's say, control freaks in a good way.
Mm-hmm.
They don't trust the pure financial flow. They want a logistics person to physically acknowledge the transaction in the system.
So it's like a fake receipt.
A statistical one. It doesn't add any stock to your balance sheet. It's just a phantom entry to say, yes, we agree this happened. It closes the loop.
Okay. Now, right next to third party is IPO individual purchase order. The notes call it pass-through logistics. How is that different?
It's subtle but critical. In third party, the goods go vendor to customer.
Right.
In IPO, the goods go vendor to us, then to the customer.
Why bring it in-house if you're just going to ship it right back out?
Usually for some value add. Maybe we need to do a quality inspection, or maybe we need to slap our own branding on it or bundle it with another product we make.
But isn't that just standard inventory then?
The difference is allocation. That stock is hard allocated to a specific customer's sales order from the moment we order it from our vendor.
So I can't grab it for another client, even if they're a VIP.
Not easily. And the risk here is dead stock. If that customer cancels their order while the goods are in transit to us, we are stuck with a custom item that is hard linked to a dead deal.
It's fascinating how these subtle logistic shifts completely change the financial risk.
Absolutely.
And speaking of moving stock, let's get into moving things between our own buildings. The sources call this the logistics versus legal battle.
Stock transport orders, or STOs. This is where I see the most integration collisions on projects.
Collisions between who?
Between everyone. You've got materials management trying to procure stock, SD trying to ship it, and finance in the corner trying to figure out if we owe taxes.
Okay, let's break it down. The notes really distinguish between intercompany and intercompany.
This is the single most important question you can ask. Are you moving stock between two plants in the same company code or different ones?
Let's start with intracompany. Same legal entity, moving from the factory to the warehouse down the street.
Okay. In the eyes of the law, you're just moving your wallet from your left pocket to your right pocket.
No.
You cannot sell it to yourself. You cannot make a profit from yourself.
So no revenue recognition.
Zero. It is purely a logistics movement. And the litmus test is the company code. If the source and destination are the same, you must disable pricing and tax determination.
What happens if a junior consultant forgets to do that?
You create a compliance nightmare. The system calculates VAT on that move, and your company ends up paying real cash tax to the government on its own inventory. You are literally lighting money on fire.
Ouch. Okay, so what about intercompany?
Now it gets interesting. Say Samsung Germany moves stock to Samsung France. Same corporate group, but legally they are separate entities. This is a sale.
So Samsung Germany actually bills Samsung France.
They have to. Goods crossed a border, legal title changed hands. This requires transfer pricing. You can't just pick a random price. It has to be an arm's length fair market value.
Ah.
Otherwise, regulators think you're shifting profits around to avoid taxes.
So the supplying company books revenue, receiving company books costs.
Correct. And where this gets really messy is with returns.
Why are returns harder here?
Because of the financial trail. If Samsung France sends those phones back, you can't just throw them on a truck. You have to reverse the financial transaction. You need a credit memo. If you don't, Company A keeps the booked revenue and gets the stock back.
Artificially inflating their value.
And auditors look for exactly that kind of thing.
So the real lesson here is don't start with the T codes.
Never.
Yes.
Start with the legal entity chart. Ask who owns this at step 1 and who owns it at step 2. If you answer that, the SAP configuration becomes obvious.
I want to shift gears to hidden money. The notes have a section on rebates that, honestly, reads like a horror story.
Rebates are what I call invisible debt.
How so? Isn't a rebate just a discount?
No, and that's a dangerous misconception. A discount happens now, I take 10% off, you pay less, we're done. A rebate is a promise to pay you back later, based on how much you buy over, say, a year.
So the customer pays the full price today.
Yes, and the company pockets that cash. But, and this is the huge but, that cash isn't really all theirs. They owe a chunk of it back.
So you have to account for that future liability.
You have to make accruals. Every time you issue an invoice for $100, if there's a 3% rebate deal, the system needs to silently post $3 into a special piggy bank account, a sales deduction.
And if the system is configured wrong and doesn't do that,
Your profits for the first 3 quarters look amazing. You're popping champagne. Then Q4 comes, the customer hits their target and says, hey, where's my $1 million? You have to pay it out of cash you didn't reserve. Your profit falls off a cliff.
that sounds like a career-ending move for a CFO.
And for the SD consultant who built it?
There's another term here, retroactive billing. The source calls it a time machine.
This happens all the time. Your sales team closes a deal in June, but to sweeten it, they agree the rebate applies to all sales going back to January.
So the system has to look backward in time.
You have to go back, find every single invoice for that customer for the last 6 months, and retroactively calculate what the accrual should have been on each one.
That sounds computationally brutal.
It is. In older SAP systems, this relied on a table called VBOX. Rebuilding that table could literally lock up the database. You'd have the IT director screaming because no one else can post an order while your rebate job is chewing up all the system memory.
Speaking of chewing up memory, let's touch on AB at Query. This is pitched as a way for users to build their own reports without code.
It's a double-edged sword. It's great for simple questions like, show me all orders blocked for credit. It empowers the user.
But the notes warn about Cartesian products.
It's a data disaster. A user tries to join 2 massive tables, say sales orders and billing documents, but they forget to define how they link together. They don't specify the matching key.
And what happens?
The system does exactly what it's told. It tries to match every line in Table A with every line in Table B. If you have 10,000 orders and 10,000 bills, the system tries to generate 100 million lines of output.
And the server just melts.
The server hangs, other users get kicked off, and the system admins come looking for you. The governance lesson is simple. Don't let just anyone build joins on live production data.
We've covered so many technical traps, but I want to close with the final segment of our source material. The real world. The reality check.
Right. This is where we leave the textbook. You can know every transaction code, but if you don't understand the project lifecycle, you will fail.
It starts with the blueprint. The notes claim 90% of SD success is decided right there.
It is. The blueprint is where you map the process. And there's a golden rule here. Do not automate chaos.
Do not automate chaos. What does that look like?
It's when a client says, we use this broken Excel spreadsheet to calculate tax, then we type it in. A bad consultant says, okay, I'll write a program to upload that spreadsheet.
Dan, a good one.
A good consultant says, no, that process is the problem. We are going to use SAP's standard tax logic. If you just replicate their legacy mess in an expensive new system, you haven't solved anything. You just made the mess faster.
And SD doesn't live in a vacuum. The integration points seem to be where the real friction is.
SD is the trigger for everything else. That's the scary part.
Yeah, so...
You save a sales order. You just triggered MM for availability. You posted delivery. You just triggered finance for revenue and costing for COGS. You change one date. You might have just wrecked the production schedule in PP.
It's a ripple effect.
Exactly. A junior consultant panics when an error pops up. A senior consultant predicts the ripple. They ask, if I change this, does it break the credit check in finance?
And you catch these ripples in integration testing, I assume.
That's where you're supposed to.
Yeah.
Unit testing, I click the button, the order saves. That proves nothing. You have to test the whole chain. Order, produce, ship, invoice. That's where things break.
And finally, cutover, the moment of truth.
The bridge to go live. The scariest part is data migration. I've seen projects where they loaded the pricing master data with a decimal place off.
Oh.
Day one arrives. Orders start flowing. But every single invoice has the wrong price. You have this CEO screaming at the project manager. It's a nightmare you never want to live through.
That really underscores the difference between knowing the inputs and understanding the outcomes.
That's it. Juniors know how to create an order. Seniors act as detectives for liability and timing. They ask the uncomfortable questions during the blueprint so they don't have to apologize during support.
So if we pull this all together, we've traveled from the ghost inventory of consignment
Through the legal maze of intercompany STOs.
into the hidden liability of rebates.
And finally to the battlefield of a project cutover.
If you had to summarize that golden thread for everyone listening, what is it?
The golden thread is that SAP SD isn't really about sales. It's about value flow. The configuration, the typing, that's the easy part. The real job is understanding how logistics, legal, and finance all pull on that same thread. If you pull too hard in one place, you unravel the others. Your job is to keep the thread intact.
That's a powerful visual. And before we go, I want to leave our listener with one final provocative thought from the source notes. It says, performance issues are often architecture issues.
Right. If a report is slow, don't just blame the code. Ask if you're making the application do the database's job. But there is a deeper question lurking here, especially now. We're all moving toward S/4HANA.
The next generation of SAP.
And it changes the rules. Remember those rebates we talked about? In S/4HANA, the classic rebate module is gone. It is literally obsolete. It's replaced by something called settlement management.
So the T-codes, the menus we discussed, they're disappearing.
The T-codes are dying, but the business logic, the concept of who owns the stock and when do we accrue for this debt, that is eternal. So the question for you is, how much of your knowledge is just memorized menus that are about to expire, and how much is that eternal understanding of business flow?
A crucial question for anyone planning their next career move. Thanks for helping us decode all that complexity today.
My pleasure. Keep pulling the thread.